Good morning, everybody. We have CJ.
Hi.
Heather from Guild Mortgage, which is Cherry Creek. So explain what happened with the merge.
So Cherry Creek merged with Guild, so now Cherry Creek is a division of Guild Mortgage. So we have more loan options, pretty much.
Sweet.
Yes, we don't need more.
Give me just like 4 basic loans. We're not rabbit holing today.
About conventional, FHA, VA, and rural development.
Okay.
4 basic loan programs.
Everything falls under those
Everything
somehow.
falls under there. Yep.
Okay.
Little umbrella.
Okay. CJ, do you want to be a first-time home buyer?
Yes, as a matter of fact, I just experienced it, to be honest.
And it's as fun as they all say?
Actually, it was really interesting. I hadn't bought a house since 2003, so a lot has changed since 2003. And I purchased an FHA loan as an independent contractor because I am. So let's talk about the process of an independent contractor buying a home, an FHA home. So what do they need to come to the table?
So when you are self-employed, for FHA loans, you need 3.5% down.
Okay.
But then when you're self-employed, you don't get W-2s or pay stubs, so we need your tax returns for 2 years. And then we take your income off of your tax returns.
Do you take the income, and I had this question, off of the income that I make on my personal, or do you take it off of my business?
So we take the net off of your business, and then we can add, there's add backs in to it to calculate that, and then it depends on how it flows over into your personal. So we use both taxes.
And you just do an average of 2 years?
Yeah, depending on the calculation. So there's a form that we have to fill out with the income and the deductions, and then we can add stuff back in, and then they give us an average of the last 2 years for your income.
So basically, don't be self-employed. No, just joking. Don't be self-employed because it was harder.
It can be.
It wasn't as difficult as I thought it was going to be, though. But if you got to have your paperwork, and you have to be consistent in your paperwork. So I have an accountant and I have a bookkeeper, so they kept my paperwork pretty tight. So it was super easy for me, and I got a good rate. So it worked out very well. It did.
Good.
Yes.
It just depends if you have enough income to support your debt. A lot of times people don't have enough. They make enough income,
They just don't show it.
but they don't show it on tax returns. So it's on how if the accountant's good, like she said, then the income will show for your debt to income ratio. So it depends on how your income shows.
Okay, so I'm going to pretend I'm a very first-time home buyer, okay?
Okay.
So I'm walking into you and I'm saying, I would like to get a loan. Tell me what you ask and what documents I need so everybody understands what they need to prepare for.
So to get pre-qualified, we talk about a loan application that includes pulling your credit. So we want to see where your credit is. And then the documentation is your income and assets. So that's going to be 30 days of pay stubs, 2 years of W-2s and tax returns, and 2 months of bank statements. And then if you're pulling down payment money from a 401k, we may need your retirement statement. But those are the basics of what we would need financial-wise, and then we pull credit and we see what your debt-to-income ratio is to see what you can qualify for.
How long do I have to have my job?
We do a 2-year history, so we need to make sure you're employed for 2 years. And depending on if we're using any of your overtime and how long you've been in your job, preferably we like somebody on their job for 6 to 12 months, but if you have a good job history, you can be on your job for a month. But we do look at your 2-year work history.
How many jobs can you have in a 2-year period?
So it depends on the loan program we're going to do. Mm-hmm. So FHA does have rules with 4 jobs in 1 year and 6 jobs in 2 years. So if you've had 4 jobs in 1 year, we're going to have to wait till you have 3 jobs in 1 year. So you may have to wait a while before you qualify, or you may have to go on a different loan program.
Is that just with FHA?
FHA has those hard and fast rules, yes. But then other loan programs, you may be okay with conventional, but they're going to look at your job stability. So why do you have those jobs?
And if it's in the same field, do they still?
If it's in the same field and you improved each job, you moved up in your field, and you made more money and you improved yourself, that's a compensating factor.
Okay. Okay.
So let's talk about interest rates, because that just seems to be the big deal with anybody anymore, but trying to purchase a house and trying to get to the table, and then the interest rates. So how do you determine the interest rate for it?
So the interest rates depends on the program. So your down payment assistance programs, WCDA, Welcome Home Wyoming, they have their set interest rate. Doesn't matter what your credit score is as long as above a 640 or 620. They determine it with the loan program. And then with interest rates other than that, just a regular conventional FHA, RD, VA loan, it depends on what your credit score is as well as how much money you're putting down. So obviously the higher the credit score, if your credit scores are 800s versus 600s, you're going to get a better interest rate.
Is that still the same with that new thing the government rolled out?
So they did
with the interest rate.
With the interest rates, they did help with that with the higher credit scores as well as loans. They just took off the high credit scores.
So they are still manipulating it a little
There's a
bit?
few things that they're working on. I can't remember the exact rule on which, but they are helping so it doesn't hit those good credit borrowers with the interest rate.
Good, because that
The lower
was
interest, or with the higher interest rate, yes.
that was frustrating.
It was, definitely.
So I know when you do a loan, you have closing costs and you have prepaids. Get into it, sister.
So closing costs are everything that we have to do for the loan. So it's going to be my fees, title fees, appraisal fees, a credit report, a flood cert, anything that we have to do for the loan. A prepaid is going to be a prepaid interest for the days of interest. It would be prepaid, you're going to pay your home insurance up front, and we're going to start your escrow account for your home insurance and your property taxes. So prepaids have to do with those prepaid expenses. And then your closing costs is everyone that has to do part of your loan, those fees. And then, so for closing costs and prepaids, they can be, you can get the borrower or the seller to pay them, and they are generally 3 to 4% of the purchase price in rough numbers.
So a lot of people get closing costs confused with a down payment.
Yes, totally separate. So down payment is off the purchase price. So a down payment depends on the loan program. So if you go a VA loan or an RD loan, it's 0% down. So you have no down payment, but you do have closing costs and prepaids. FHA, you have to do 3.5% of the purchase price for the down payment, as well as closing costs and prepaids for both.
Okay, so they're all completely different. So everybody needs to know that they need to come to the table, depending on the loan they're
Depending
doing.
on the loan program, they'll have to come in with some money.
Okay.
The best scenario is they only come in with their earnest money. Earnest money is generally around $500.
I don't think really people do understand what the prepaids are. I think they think that the closing costs and the prepaids are the same thing, and they are not.
They are not.
They are not.
No, and I think sometimes they think they're together is because you can get them all paid for together as like a roll. You can do 3%, 4% of it, and it's all together. But they are completely different fees, and so that does determine if they shop around for fees, and whether they go online lender or a local lender, you could have different closing costs and prepaids. Because I like to look at the prepaids are your property taxes, which are always going to vary, depends on the house. So those are going to be, different because of the house. If you have a house in a certain area that has high property taxes, even though it's the same purchase price as something else, those are going to be different. So your prepaids will fluctuate. But that also helps them set up an escrow account for those prepaids, so that way your tax and insurance are in your payment for your mortgage payment.
So it's taxes, insurance, and prepaids, and what you get paid, correct?
What I get paid, what title gets paid,
Yes.
appraisal,
Okay.
everybody that has to work on your loan.
Okay,
that we
perfect.
need something for those loans.
And let's talk about Wyoming loans because we're starting to experience where people are moving around, and I got a pre-qual letter from Meridian, an out-of-state lender, and I'm not going to mention any names, but I couldn't get my buyer to switch over to a Wyoming lender because they could get better interest rates, they can get better things than, because we're using WCDA, we're using specific things, and I couldn't get her to switch. Is there a difference between an out-of-state lender and a Wyoming lender?
I think there is, not only like you said with the loan programs, that
Right.
Wyoming has more loan programs. Out-of-state or online lenders don't have specialized Wyoming products.
Correct.
But they're not familiar with certain fees for us or appraisals. So they don't know maybe the cost or the turn times for appraisals. Certain fees, we don't have transfer tax fees in certain loan programs or surveys. There's some things that we don't have in Wyoming that online lenders or out-of-state lenders know, and they don't know how the flow works with your own local lender.
It'd be like us selling real estate in Alabama.
Absolutely, yes. It pushed her out of buying because I couldn't get her to come and use a lender in Wyoming, and it pushed her out of buying because she didn't want that kind of a payment.
Because I've had people, that's with people with, I had one gal with an out-of-state lender, and her interest rate was a lot higher than what I could get for her for being a first-time home buyer with WCDA.
Your interest rate was higher, or the out-of-state lender?
Out-of-state was higher and
Yes.
wanted her to put 3.5% down.
Correct.
And I could get her a lower interest rate and only put $1,500 down. So it's important that buyers know that there are more loan programs.
How many loan programs do you feel like Wyoming kind of has? Like if you were to do something, just a rough number of how many programs you could throw somebody into.
Generally, I mean, just simple wise, I could throw somebody into 3 or 4 loan programs. There's hundreds of loan programs out there that fall under those 4 loan types. But borrowers generally always have 3 options, maybe 4 options. It just depends. Like if you're a veteran, you have your VA option. If you find a house in RD, if you find a house, the Rural Development RD, if you find one in Glen Rock, Mills, Bar None, Evansville, that's another loan program. And then, conventional FHA, as well as you have your down payment assistant programs. We just came out with one yesterday with another down payment assistant program. It's 1% down of the purchase price, and then 2% is a grant that you don't have to pay back. And that's something that Guild is doing independently. But there's so many different programs out there that when borrowers want to come get pre-qualified, I like to give them those options. There is more than just one option, which again, sometimes out-of-state or online lenders don't have that many options. They just put them into one option and this is what they can do. So it's important to know that you have more than one option.
When is the best time after we go under contract to lock the rate? Because they don't understand that either. So locking the rate is, I think you lenders will know when the interest rate may be going up or going down, and then you lock in the rate. But is there a specific time in the 30-day, 40-day contract do you lock the rate?
So on some of the loans, if we're closing less than 30 days and some maybe a WCDA loan, and rates with WCDA are different, how they shift in the market than just a regular FHA, I may just lock it.
Okay.
Or if we get information where they think that we get a lot of information that tells us where the rates are going to go, and if the rates are going to go up higher, then we want to lock them in. So we just kind of want to see where the market is, and we have that discussion with the borrower as well. Is, do you want to risk it and see where the rates go? Do you want to just get locked in and not look back?
Are your clients buying down the rate? Are they? I did that.
I don't have a lot of them doing it. I give them an option, but they're looking into just refinancing later. So it all depends on what you want to do. So if you want to buy the interest rate down because you don't want to deal with the refinance in a couple of years, definitely buy the rate down. Some of them are just, it's the cost. So it depends if you have the money or not to buy it down. And what you're going to do, because rates need to go down a good 1% to refinance. So it just depends on what your goal is. Are you going to keep the house? Are you going to move? Is it long term? There's a lot of those discussions that you have with buyers that you want to get the right picture for them.
Makes sense.
If
Total
they want
sense.
to do it, because sometimes it might be perfect and sometimes it wouldn't work.
Perfect. Well, maybe next time we delve into a little bit more of different loan types. Maybe have some things people can look at.
Yes, loan terms and loan options and down payment.
Okay. Well, I appreciate you coming.
You're so welcome.